There are 3 parts to this webinar: the basics, which is going over what a personal bank is, who Ferenc is, and why you might need a personal bank in your life. The next is advanced concepts. This is for people who really already have a personal bank. They're funding more. They're really wanting to create that cash flow. And the next and best one, I personally think, is a live Q&A at the end, where you get to actually talk to Ferenc and ask his questions live on the air. With that being covered, I would love to introduce to you Ferenc Toth. For those of you who may not know him, Ferenc is a nationally acclaimed educator and speaker on financial literacy. He has a knack for explaining complicated financial concepts in a simple and easy to understand manner. Ferenc gets people to think and empowers them to better understand the financial tools that they are considering. Ferenc is founder of the Join the Money movement, and he is passionate about helping people gain control of their money, earn more, pay less taxes, and having more money to spend over their lifetime. Unlike typical financial advisors, Ferenc will teach us about a powerful financial concept used by the ultra wealthy, known as your personal bank or your personal banking system. The bottom line: you earn more income, gain control of your money, and you have more money to spend over your lifetime. Ferenc has personally helped hundreds of individuals, families, and businesses establish their personal banks to enhance their financial futures, and he would be honored to help you. We are fortunate to have Ferenc with us to share this concept and in a forum where you can ask him questions. We hope you will join the money movement and help me welcome Ferenc Toth. Welcome, Ferenc. Thank you.
Thank you, Kelly. That was really great. So I guess I got to turn this on. Okay. So how's everybody doing today? Hopefully you've had a great day. I've had a phenomenal one. And of course, don't want to forget, this is the anniversary of 9/11. So we don't want to, I mean, it was a very emotional day for me. I know for a lot of people, particularly those that knew friends, family, and whatnot. So we don't want to forget that. It's a day that changed our country in many ways forever. And many of us will never forget where we were when that happened. So I just wanted to keep that in mind. A quick thought and prayers for those folks. Basically, what we're going to cover tonight, of course, is like Kelly was saying, we're going to cover the personal bank concept. We're going to cover a couple of advanced concepts here and go into some Q&A. My question, Kelly, is on the poll results. How many folks, what are we looking at as far as?
We are neck and neck. 43% is combining your investments and 57% is protecting your downside when things go wrong. So a good combination of both of those would be fantastic. So sorry, we didn't make your job any easier, but
no, we didn't.
You're good at this, so.
No, we'll make it work. And is there anybody, do we need to go into the introduction of this, or can I just kind of jump forward at this point?
You know what? Let me look really quickly. I apologize. Let me go back to that first one. Okay, we're at 20% is brand new.
Okay.
And we're at 60% have heard of it, but tell me more. And 20% is no, I'm a pro. So yeah, I would go into a short intro, but a good amount have heard of you and kind of know the concepts. So I think you can probably dive in pretty quickly.
All right. So what I'm going to do is then let me share. I'll do a very quick intro. And I apologize for those of you if it's your first time. We're going to be sending you some follow-up information, and please reach out to us if you want more questions, because there's a lot to learn, but we want to cover as much as possible for those most appropriate. First of all, in Ferenc, like Kelly said, this is our company. We have over 5,000 clients since '96. What we do basically is our mission is to improve the financial future of individuals and families. We create sustainable wealth, secure financial future, and establish family legacies. We use a client primacy principle. First, last, every priority is designed to improve our client's situation. We use a comprehensive approach. We look at the whole picture with our strategic partners, attorneys, tax accountants, you name it. Met with an attorney today, in fact. I'll share a little bit about that because it was a very interesting meeting. How we do it is create tax-free income, eliminate market risk, and manage your personal bank. A+ rated BBB the last 15 years in a row. Obviously proud of that. there's me. What I do is teach people how to think like a banker versus an investor. And we're going to talk about that a little bit today. And then how to take control of your money, earn more, create a tax-free income, have more money to spend in your lifetime, basically, is what it boils down to. The control, that's a big piece of it. And what's important to me, of course, is my family. My older daughter was diagnosed with autism when she was 4. So it's created special challenges and blessings for our family, of course. So that's me and what I do for fun. I'm a semi-professional bass trombonist. So something I enjoy doing. I did serve in the U.S. Army, Old Guard, D.C. Played there too. Did military funerals. Played taps, bugle. So those were touching times and impacted my life in many ways. So again, today's goals: how to enhance our financial lives. And basically what we're going to do is since we got not so many new people, more people that have been with us, I'm going to kind of jump in with really the problems that I talk about. I'm not going to spend as much time with the problems because I want to really get more into the solutions of what we talk about. So we're going to jump forward quite a bit on what I share a lot. The only thing I want to share is is one of the number one financial obstacle. See, the number one financial goal for most people is creating enough sustainable wealth. And one of my comments is always, let's see, most people, do they have sustainable wealth? Okay, because that's the most financial goal. That's the number one financial goal for most people, of course. Do they have that? In other words, an ongoing income? And the answer in most cases is no. So I always say, if they don't have what you're looking for, whether they be an advisor, a friend, or anything else, why listen to them? So you want to, I say, if you're expecting the same investment advice as you get everywhere else, stock, bond, mutual fund, diversify, you're in the wrong place. But if you're looking to do what the wealthy do and create sustainable wealth, you are in the right place. And that's what we do. So again, financial advisors are taught we need income when we retire, which is true, but we need it all the way throughout our entire lives, don't we? When the car breaks down, or we lose our business or job income, or we get sick or whatever, and when we retire, we need income. So in other words, what we need is cash flow, okay? Very few people focus on cash flow. Very successful people do, but most don't. And if our primary financial needs are solved by cash flow, why do most investors focus on appreciation instead? Well, the answer mostly comes from Wall Street. Why? It's really quite simple. How do you make money when you invest with a typical financial advisor? When the account goes up in value, which is appreciation. How does a financial advisor make money? Well, they get paid fees when your account goes up, down, or sideways, right? So Wall Street's happy to give us all the appreciation. They want the cash flow, which is smarter. Appreciation or cash flow, something you got to consider. So that's to create cash flow. You've got enemies of that. Again, the main enemies of creating cash flow is consumer debt, taxes, and market risk. Again, I don't want to spend a lot of time on those. You got to understand, you want to get rid of consumer debt. Strategic debt you can become wealthy from that, but consumer debt you want to get rid of. What is consumer debt? Debt that you have to work to pay off. Get rid of that. We can help you do that. We show people how to pay off mortgages, for example, 30-year mortgages in 7 years using the same dollars. I can show you how to do some of those things, but that's for a different day. Taxes, pay less in taxes. There's all kinds of benefits, tax-free income, things you can create, and that most financial advisors don't know about or use. And then want to eliminate market risk. We're going to talk a little bit about more of that later because I want to talk about how to protect the downside. Okay, so those are the problems. What's the solution? Well, basically the solution is creating a personal bank. And why is that the solution? Well, it's real simple, and I'll share with you right here. So we're going to jump to the solution. If I'm going to share with you how to create a personal bank, first of all, you got to learn how banks operate. Now, by the way, you got to think like a banker versus an investor. By the way, I had several meetings today, meeting with other board members. I'm on the board of Rio Salado Bank, which is a community bank here in Phoenix. So I'm on the board of a bank, so I think I can teach you how a bank operates and how a bank thinks, okay? And here's the difference. And I was sharing this with a couple of folks today, and it just made a lot of sense. Investors trade hard-earned dollars for assets with the expectation the asset will increase in value. They focus on the potential upside, typically only, creates little or no cash flow, and rarely asks what's the recourse if things go wrong. Well, if you purchase a stock, real estate, or a business, can you tell me what it'll be worth in a year? And of course, the answer is no. You can guesstimate, you can look at charts, you can trends, but you really don't know. And according to Rich Dad, Poor Dad book, Robert Kiyosaki, investing primarily for appreciation is just another form of gambling. See, the return is uncertain, little or no cash flow, and there's no downside protection. So I always say, if you've ever taken a mortgage or a car loan, most of us have, when you signed the papers, you knew you would have a payment. And understand, this is how a banker thinks, okay? This is what I'm helping you walk you through here. Did you plan to make the payments? Of course you did. You wouldn't be signing the papers otherwise. Banker knows that also. They want your payments. And if you didn't make those payments, what would have happened? Well, they would have taken the asset. Is the banker really risking their money? And the answer is no. Collateralized loan lenders hardly ever lose money because they've created a secure cash flow, your income, your payments, and protected their downside, collateral, right? So the criteria for any good investment for a banker is creating a secure positive cash flow. One of the reasons I'm a fan of rental real estate, for example, cash flow real estate. Collateral, downside protection. You know, if the person doesn't pay you rent, what do? You take the house back and rent it to someone else, right? That there are many other examples you can do this with notes and with tax liens, and there's other investments that create this. I'll share another one with you that accomplish those things for you. Why take on all that risk? And like I said, an investment's a bad one if there's little or no cash flow and no downside protection. It doesn't matter what the potential return is. It doesn't matter. They're not going to make that investment. So to create a bank, first thing you need to do is understand how a bank operates. Now, when we get a check, what's the first thing we all do with it? We put it in the bank. What's the bank do with our deposits? Loan it out to earn compound interest. Now, I know I'm going over this again with some folks who've seen this before, but it's critical to understand this process because this is where people get hung up about how the personal bank really operates. So you got to do what the banks really do. Let's assume you open an account at a bank, then the next person wants to get a car loan. Does the banker give the money you just gave them to the car loan person? Most people think yes. The answer actually is no. They keep it in the safe, borrow against the cash to make more interest. And my question is always the same. Is cash an asset? Of course it is. Can you borrow against an asset? Of course you can. We do it all the time with houses and cars and 401ks, for example. You can do that for other assets too. Now, you want to do what the banks do. You know, banks don't invest in the stock market. Chase, Wells Fargo, B of A, pick a name, it's all public record. They actually earn compound interest on our deposits, borrow against the cash they hold to earn more, so can you. And how we do it? Through a personal bank, we create an asset that's guaranteed and insured. This is key because we want access to our capital. I always get asked this question, day one, okay? You can turn your capital around right away, and that's super important because that gives you control of your money. Most investments, you actually don't really have control of your money. You may have liquidity, but liquidity is different than access and control. I'll share a little more of that in a bit. You earn interest on your asset and the borrowed funds. This is a powerful key point to understand. Of course, tax-free growth and withdrawals. Now, by the way, by setting up a personal bank, you create 2 to 16 times more total dollars to spend in your lifetime doing this versus not. And that's just a factor of how long you're going to live because of something called compound interest. Compound interest, as most we know, 1 goes to 2, 2 to 4, 4 to 8, 8 to 16, and so on. The longer you live, the more you get that compounding, okay? Now, the product we use, the tool we use is insurance. Now, sometimes people get surprised. Well, you shouldn't be, because it's a process of elimination. And please don't misunderstand the tool from the concept, okay? We could use any financial tool and operate like a personal bank, but there's specific reasons why this is the best tool for the job. And an analogy I use all the time is this. Can you cut a tree down with an axe? Sure. Can you use a chainsaw? Of course. Which is more efficient? This is the chainsaw. So in other words, if you're going to create an asset that grows for you in the future, you want compound interest. You want an increasing cash flow. Well, that takes a lot of market-related type investments off the table because they vary in value, right? Or don't create a cash flow. We want no risk of loss. We don't want to borrow against an asset that can lose value, obviously. So that takes everything market-related off the table now. We want liquidity. We want access to majority of our money day one. Well, CDs and some annuities have the safety and compound interest factor, but they don't have the liquidity. So they're off the table. We want access to our funds. We want no penalties or age restrictions or other things. So the IRA 401k world is off the table. And I have to laugh. I got asked a question today by an investor about a self-directed IRA at a meeting I was at this morning. And I just laugh because I get asked these questions all the time about IRAs. And I'm like, what I say to people is you're so caught up in that world and so used to that world. And when you start looking at getting outside of that world, it's almost like a get out of jail free card. We all know there's a lot of rules with IRAs, penalties, taxes, contribution limits, distribution requirements, all kinds of rules you have to follow. Well, when you get outside of the IRA rule, guess what? The rules fall away. It's your money. You're back in control again, aren't you? I argue often that if you are a majority of your wealth is building into IRAs and 401ks, for many people, you've lost control. Because as we know, you can't touch it till you're 59 and a half. What if you're 30 or 40 and you need the money? What if you have a business or an opportunity to invest? You know, you have limitations and restrictions that can keep you from being able to do that. You lose control of your money, okay? And I guess I'm just a fan of, I think, who's going to watch your money better than, and who else is going to watch your money better than you? You know, no one. It's you. You maintain control. You get empowered. It's your money. I can help you and give you direction on how to best use it. But here's the reality is you're in control. You're empowered. And that's what we go around trying to teach people and help people do. Tax-free growth, tax-free withdrawal, tax-free the heirs. That's awesome. In fact, in the entire financial universe, of all the financial tools that exist, this is the only one that does all of these things. So that's why we use that tool. Now, the biggest challenge I have is I say to somebody, you need to look at setting up a high cash value insurance contract. And some people turn off because they view insurance as an expense. Like, oh, great, I got the home and the auto. I don't need another bill. Stop listening and miss the whole point. That's not what I'm talking about here. What I'm talking about is a type of insurance called high cash value investment grade insurance. This is the type that banks and corporations purchase to enhance their balance sheets, okay? In fact, it's called, for those of you in the financial industry, it's called Tier 1 capital. It's considered the safest money that a bank or corporation can own. Now, there's many types of investments, there's many types of mutual funds and everything else out there that do different things. There's many types of insurance out there that do different things. Most are not effective with the personal bank. And we got a little bit of time here. We can go into the different types for a sec. I mean, there's term, there's variable, index universal, universal, and whole life. Those are the 5 main different types of insurances that exist out there. And out of all of those, only 2 types can work at all, and one works the best, okay? And it's because of the guarantees, guaranteed growth, guaranteed costs and fees, which creates a guaranteed annual cash increase. So without going into a lot of detail today, if you want more information on that, I'd be happy to share that with you in the future. But that's why we choose that type. And some people say, well, I've heard negatives about it. Well, whole life is called whole life. We use a whole life chassis because it's guaranteed for your whole life. The costs are guaranteed for your whole life, and the growth is guaranteed for your whole life. The others are not. So the value, the cost will go up, and your returns may or may not be there. Do you want to borrow against an asset that doesn't have a return because there's a bad market year and you have increasing costs? Guaranteed. That starts to not make sense. And when people understand that, they realize why we use the tool we use. Now, when it comes to life insurance, I always when I do a workshop or something, I love asking this question. I'll say, how many people in the room have life insurance? And third to half of the room, hands will go up. And I'll say, no, you don't. And sometimes people even argue with me, yes, I do. No, what you have is death benefit protection. You have a contract or a tool. It's not really designed to generate cash. Yes, the agent that sold it to you might have showed you a little bit of cash, but the reality was it was designed as a death benefit protection tool, not a financial vehicle, okay? And 99% of contracts are structured this way. low or no cash, term has no cash. If you think of teeter-totter, you maximize, and you're maximizing death benefit, okay? Well, think about that a minute. Where's the risk to an insurance company? It's the death benefit. When you get hit by that ice cream truck, they got to write a big check, right? So where do you think the fees and costs are going to be to mitigate that risk associated with the death benefit? If we do the opposite, maximize cash, minimize death benefit, we can lower the fees and we can maximize the cash. And there's significant amount that you could do. And for those technical types, it's called the MEC rule, or modified endowment contract. It's been in the tax rules for decades. And there's a lot of flexibility and fluctuation on what you can do. Most agents, most advisors have no idea that this can be done, because the reasons, there's a couple of them. One, if we maximize cash, the agent gets paid less commission. So right there's incentive for the agent not to bring this to your attention. Two, when insurance companies recruit agents, they show the big death benefits and the big commissions. That's how they, that fires people up, right? So they don't talk about the lower commissions and the lower products that are actually better for the client. So it's not really taught or focused on. So that's why, okay? So my question is real simple. If you have a life insurance policy, does it have a value? In most cases, the answer is yes, it does to your beneficiaries, okay? It's actually what's called a guaranteed cash contract. In other words, again, you get hit by an ice cream truck and your heirs get a check. It's really that simple, okay? Can you borrow against a cash contract? That's where I get a lot of question looks. And the answer is, in most cases, no. But there are certain contracts available that allow you to access a percentage of the death benefit today. Why is that so important? Well, if you have an insurance contract on you, a death benefit contract on you, will you ever see that money? The answer is no. Will your heirs? Yes, of course. But you will never see that money. Now, what if you could access a portion of that asset today? Tax-free, guaranteed, and never had to pay it back. Have any ideas what you could do with that money? Could you pay bills off? Could you purchase things? Could you invest in things? The answer is yes, of course you could. It's your money. There's no rules. There's no restrictions, okay? Now, the policy loans is basically when you access funds from it, you're taking advance on the future death benefit. Again, something you will never see. It reduces the death benefit, not the cash value. Because you did not remove or withdraw any cash, your cash earns compound interest the rest of your life. You have a guaranteed increasing funds every year, or in other words, cash flow. I looked at a case today for a client who had set hers up nearly 4 years ago. She ran into some, this is interesting. She ran into some financial challenges. She got it started the first year. She added some monies to it year 2. And then year 3, she actually went back to school to get another degree, stopped earning income for the next 2 years. Put no money in it. And she called today wanting to know if it was still alive, if you will, and what she just got a new job. She got a raise because she's got a new degree in the medical field, making good money now, and wants to get this thing going again. And we're like, it's fine. It's been carrying itself for the last couple of years by itself. Why? Because the money that was taken from it was taken from the death benefit, not the cash. I'm going to illustrate that a little further. So there's lots of flexibility with these things. And that's what I say, if you look it up and then one of the negatives you run into out there is they're not flexible. That's not true anymore. In the past, that was true. You're talking about information that's 6, 8, 10 years old now, okay? Things have changed, things have improved, right? The other thing is, people always say, well, if I take a loan, if I access funds from it, there's a cost, okay? Yes, there is, but here's the neat part. Interest paid on the cash is the same or higher than the cost of the loan. Or in other words, the interest rate charged. The net cost for the loan, therefore, is 0, or in other words, is known as a wash loan. Now, the amount you're paid and the amount you're charged is a wash, okay? That's pretty cool. It's free money, but it actually gets better than that. And I always tell people, this is to really help understand the gist of how this works. You think of your money in 2 buckets. When you set up one of these contracts, you have a cash bucket and you have a death benefit bucket. And when you want, and you're credited interest into the cash bucket, okay? When you want to access funds from it, again, most contracts require you to take from the cash, which means you kill future growth. By the way, isn't that how most investments work? If you have an IRA, a 401k, a mutual fund, a CD, an annuity, I don't really care. Take your pick. Whatever the financial tool investment is, you have an account and you take some of the money from that account and spend that money for whatever reason. What's the future growth of that money on that account? Reduced. In fact, the money you spent is zero because the money's gone, right? It's gone forever. And this is a powerful key thing to understand. You never want to spend money, never want to give up control of the money. You want to have the money in your control so you can earn interest on it in the future. We have needs for money to spend. I get that. Why not take that money from an advance on your future death benefit that you'll never see? So I even get asked questions about this. Well, I'm single. I don't have any family. I don't have kids. You know, should I do this? Yes, of course. You're spending the kids, you're spending the future death benefit that you'll never see. Some people say, well, I'm spending the kids' inheritance. Exactly. Okay. You'll never see that money. You created that asset, that death benefit contract that has a value at some point in the future, but you're getting a portion of it today to spend. So your cash in your cash bucket, all it does is just keeps growing, keeps increasing because of interest it's earned and any money you add to it. Okay. The death benefit, if you take funds, if you access funds from it, again, you reduce your death benefit, and then the interest is charged also against the future death benefit if you don't pay it back. That gets interesting. So in other words, interest is earned, is paid into your cash bucket, the red bucket. Death benefit bucket's reduced if you have a loan. You have a net gain when borrowing. You make money on the borrowed funds. And basically what has happened now is you have become a banker. Pretty interesting, huh? So there's no loan repayment terms. There's no requirements. You have use of your money. If you can pay it back if you want to, of course. If you have extra money, should you? Of course. But you don't have to. The death benefit's the collateral. So if you never pay it back, it's just the death benefit's lower to the heirs. Okay? It's really that simple. Do we have any questions so far, Kelly, that we should address? Okay.
We actually have a couple.
Excellent.
A few of them, just to let everybody know, you will receive an email after the webinar that you will receive the documents as well. Just wanted to let everybody know that so that you can really just pay attention and listen. The other thing, Ferenc, just really quickly, I know you're very animated, so I'm not sure if your microphone is just on your shirt, but it's kind of it sounds breezy. Just thought I would let you know. Okay. I know you talk with your hands a lot, so it could be that. So our basic question, and please, I know I'm texting everyone in the background, if you have an awesome advanced question, you know, after he gets through the advanced concepts, give him one. Give him a really hard one. Ferenc likes that. It'll end his day with a smile. But I know you did say it was a little bit of an emotional day, so maybe don't be too hard on him. But our basic question that we actually have Dana. Dana would like to know that she has just recently graduated with her undergraduate degree a couple years ago, and will be going back to school this semester for her master's degree. Okay. She's curious to know if she could use her personal banking account for a loan for her continued education and earn the interest as I pay off the loan. I guess my main question is whether the personal banking method would also work for education-based loans. And we'll go ahead and let you address Dana.
Absolutely. The answer is absolutely yes. In fact, what I would say is this would work for anything that you have a need to spend money on. So whether it's an educational loan, you're purchasing an item, paying off debt, or you want to invest in something, it's going to basically work the same way, Dana. So let me walk through a little process to understand how this would work. So for example, there's three numbers that are key importance when you get a statement. that are of importance. The first one is the gross cash value. So we're going into the moderate level stuff now. We're easing into some advanced stuff now. So the gross cash value is where you're credited interest. The net cash value is the remaining funds available to access from the death benefit. I'm going to explain that further in a minute. The death benefit, of course, was paid to the heirs. Most people understand that. So I'm going to use an example. I don't know what Dana's numbers look like. It doesn't really matter. The principle is going to work the same. Whether you add a zero or take away a zero, it doesn't really matter. And by the way, as I'm bringing this up, one of the meetings I had today was with a attorney of one of the two largest law firms in Arizona. Actually, he's a founding member, partner, and he's looking to retire soon. I won't say the name because some of you know who he is, but he said, I've looked into this, and this is really exciting. And he thought, he goes, the only reason I haven't started it, and he says, I've researched this extensively. This is a very sharp guy. He said, but I was told I have to fund this over 7 years. And I said, no, that's not necessarily true, because he wants to retire sooner than that. And he said, okay. And we talked a little while. He goes, okay, run me some numbers. I'm very interested. So I'm pretty excited. We'll see what happens. So again, whether it's big numbers or smaller numbers, doesn't matter. Don't get hung up on the numbers. What I want you to understand is the principle of how this works. So I'm going to use an example of 100,000 cash. Again, it could be 10,000 cash, it could be 1,000 cash, it could be 1,000,000 cash, doesn't matter. But what's the gross cash value? That's the money you've put into this. That's your green bucket. The cash bucket, it's the contributions you've made plus any interest it's earned. Now, how would you get to 100,000? Well, some people have the wherewithal to dump that in right all in one shot, okay? Others, it might take them a number of years to get to that point. Doesn't matter, okay? But let's say you got to that point. Now, your net cash value at that point, it would be the same because there's no loan against it or anything. You have access to whatever, is there, right? And let's assume the death benefit was $1 million at this point, okay? Wouldn't be, depending, somebody fairly, relatively healthy and relatively young, that would work. If you were older, by the way, I get asked that all the time. What if I'm older? I've got clients who've done this that are literally 79, okay? We can do 15-day olds too, by the way. So that's sort of the range, just about everybody. The difference, the cash is going to be the cash. If you're older, the only difference is your death benefit would probably be less because of your age or health. So although you might be on the older side of things, doesn't matter, still works for you, because are you doing this for cash or are you doing this for death benefit? That's the question I always ask. So again, the interest is credited on the cash bucket. Okay, now let's walk through this process. Now, if you're paid 5% on 100 grand, obviously, a year later, you would have 105, right? Because the interest was paid on the gross cash, right? You would also, your net cash would be 105. You'd have available 105 you could access against that future $1 million death benefit, right? Okay. Now, let's assume a moment we decided to take a loan. We decided to access the funds from the future death benefit at this point. And we decided to access 50,000. Could you access the whole 105? Yes. I'm just using this as an example. Now, where did the 50,000 come from? It came from the death benefit side, the death benefit bucket. So now the $1 million death benefit, what was $1 million is now $950. Most people understand that, and that's fine. So, and sometimes people say, well, I took money from the heirs are going to lose. No. What did you do with the 50,000? Hopefully something good. You either paid off some debt, you bought something, but if you were gone, your heir would inherit anyway. If you bought a $50,000 vehicle, they're probably going to inherit that, right? Or you invested in something, hopefully it was worth 50,000 or more, right? Which your heirs would inherit that. So you're not losing, the heirs are not losing the 50 grand. You see what I mean? And the other side of the coin to look at it for the heirs standpoint is, if you had $100,000, for example, and you were gone, how much would they get in an account, let's say? They'd get the 100,000 minus any taxable issues. Here, the same dollars, the heirs get 950 plus whatever you did with the money. Who won? Financially, everybody, right? So again, the funds are accessed from the death benefit. Now let's take it one next step. We accessed 50,000 from the future death benefit, and the growth. But here, and what interest would be credited? Remember, the interest is credited on the gross cash. What was the gross cash? 105. What's the net cash? 55, because that's the remaining amount of funds you could access from the 950 at this point. Remember, we back up a sec. We had 100,000. We got credited interest. We were 105 a year later, which meant We could access 105 from our million death benefit. We decided to access 50. So our gross is 105, our net is 55, and our death benefit's 99.50, okay? Remember, we get credited gross cash. Whether you have a loan or no loan, your gross cash is the same. I'm going to say that again, because if you get this, what I just said, you get it. What's your gross cash? Money you contributed plus interest it earns. Does it ever go backwards? No. Whether you have a loan or no loan, your gross cash stays the same. You get credited even though you spent 50 grand of it, in essence, didn't you? But where did the 50 come from? The death benefit side, of course, right? Now let's take it the last step. Remember there's a interest charge on loans? And remember the interest charge is charged on the death benefit bucket, right? So 5% interest charge on 50,000 is $2,500. So your death benefit that was $1 million, now $950 because you took 50. You don't pay it back. They charge $2,500. You now have a death benefit $947.5. Do you care? If you're doing this to build cash, the answer is no. And then the last piece is this. You get interest on the gross cash. Even if you later access the funds, you get interest credited on the gross cash, which is contribution plus interest. If you understand this, that means you're going to get paid interest on more and more dollars every year. Even if you didn't contribute, it'd still earn more interest every year, wouldn't it? So your interest crediting would increase every year, right? So the bottom line is this. People ask me all the time, should I add more money to this or less? Well, you get paid interest on your gross cash every year for the rest of your life, and it never goes backwards, even if you later access the funds. How big do you want that number? So to answer Dana's question fully, this is it. If she takes some money and funds her education, okay, she has a choice. She could take that money and fund her education. Oh, and when she gives that money to the university or wherever the school, will Dana ever see those dollars ever again? The answer is no. She traded the dollars for the education, which is another advanced concept and a way to protect the downside. How are you protecting your downside? You're maintaining control of your money. You're continuing to earn interest on your dollars, ongoing, for the rest of your life, okay? I'm looking for a slide to get, yeah, here it is, the wealth key. In other words, it's called liquidity versus access to your dollars, okay? If Dana takes those dollars and gives them to the university, she's given up the availability, the ability for, I've got a better concept that fits this even better. She's given up the ability for that money to ever grow for her in the future, right? So therefore, wouldn't it be better, wouldn't it make more sense? I'm going to go back to my previous slide. I don't want to confuse things here yet by jumping into another concept too quick. Would it be better to put the money into a contract, a personal bank policy, and then borrowing against her future death benefit to pay the university the education costs? What would happen? The money that Dana contributed, she paid for the university either way, right? But the money she contributed in the policy and then later accessed against the death benefit to pay the school, she's going to maintain control of those dollars, her interest on those dollars for the rest of her life. I've got to assume if Dana's going for a degree, she may not be, but she's probably on the younger side. How many times? Yeah. So how many times the 100,000 in 5 years, 10 years, 20 years? In 20 years from now, the original 100 would earn another 165,000 of interest from the original 100, even if she spent the original 100. If she gives up that 100,000 or make it 10,000, I don't really care. Like I said, add a zero, take away a zero. She's giving up all that interest gains that she could have controlled in her own life, in her own So really, if you think about it a minute, in 20 years, if she paid 100 grand for her schooling, which isn't out of line these days, by the way, okay, it's not another. I've seen people with $400,000 and $500,000 student loans, by the way. Um, think about it a minute. What did her in 20 years, $100,000 education, giving 100,000 up to buy an education, really in 20 years cost her 263,000, right? Because she lost the 100 and the interest the 100 would have earned. Where if she did it this way, she could give up the 100 but still earn another 165 of interest off the original 100 over the next 20 years. So what did her education really cost her now? Hopefully that answered the question.
I'm sure it did. We have one more beginner question real quick that I think you started to touch base on, and I think that it would answer a lot of questions specifically for the people who are newer. Let me see if I can actually open up this mic for her. While I do this, I'm going to launch a poll real quick. That way, in case you need to pull up anything while she's answering the question, you can do that. So I'm going to go ahead and start this poll, and I am going to open up the mic for Trish Williams. She is out of Washington, and she's going to ask a question that she's been asked, and she doesn't have the answer. So Trish, are you on there?
I'm here, Kelly.
Hey, Trish.
Hi, Ferenc. So I've been chatting with a lot of folks in the about the bank, and a lot of people know that both Greg and I are avid bank users now because of what we learned the hard way. We'll talk about that later. But the big question I'm getting from folks is, number one, they're worried about if they have maybe another life insurance policy, if they can be too insured, or what's the minimum. And I think you did touch on that, whether it's 1,000, 10,000. And the other one is, well, maybe they should just wait. And I'm hearing that a lot from people.
Okay. I think it kind of comes down to, Trish, really, what is it their goals or they're trying to accomplish? So the question you've heard me ask many, many times is, do you want to grow cash or do you want death benefit protection? Okay.
Right.
So in other words, it really kind of goes into, we'll spend a little time here. It goes into the different types of insurance and their different purposes, right? If you're wanting true death benefit protection, there's nothing more cost effective in the short term than term. We all know you can buy term insurance really cheap, really inexpensive premiums, monthly, annually, whatever, and you can have death benefit protection. Now, term has no cash, and we all know the term expires over a period of time. So term is not a permanent solution. And there's those people out there that, the whole A.L. Williams and stuff teaches buy term, invest the rest. That's been proven overwhelmingly to not work statistically because, well, you're taking on risk, and if you're investing the rest, for one, and it may or may not work out, and two, a lot of times people don't invest the rest, so that doesn't work either, obviously. My point is, though, a term doesn't grow any cash and it expires, so it's a temporary solution. Term is like renting versus owning, okay? But sometimes you have sometimes you have those temporary needs, like you have kids, like my girls are 12 and 14. Do I have some term coverage? Yes. To get them through college? Yes, I do, because I have that need, right? Some people have that, some don't. Now, there's variable insurance, and basically the returns are based on the market. You can never borrow from an asset, but you never want to borrow from an asset that can lose value. So the positive of a variable is it can go double-digit returns in good market years, but also can have double-digit losses in bad market years, right? And you certainly don't want to borrow against an asset that can do that. So for the banking,
that sounds like the stock market.
Well, it is. It's on the S&P 500, and you're in the market, okay? Right. So if you want to be in the market with some tax benefits, a variable life policy can work, but you're taking on risk, okay? For the banking concept, never ever borrow, never have an asset you borrow lose value. There's index universal life and universal. I'm going to touch on universal first, and then IUL, or index universal, is a hybrid of that. Universal's been around forever. But here's the thing about universal: the cost of insurance increases with age. So your fees increase with age, which means your cash values decrease with age, because more fees creates less cash, right? So for a long-term plan of building cash compounding, does it make sense to have something where your fees go up every year? You know that for a fact.
No.
No. When you're younger, it could work for a while, but you're going to want to switch over because it just gets worse and worse. IUL is the returns are based on the stock market, with the principal guaranteed. So in other words, a good market year, yes, you can make a double-digit return. In a bad year, you won't lose. That all sounds great, and it is. Sometimes some of them include a 1 or 2% guaranteed return. But if the market has poor returns, you may have no growth. And your fees also may increase, I should change that, will increase, because it's still a universal contract. In other words, every year, your cost of insurance and fees will go up, guaranteed. So it may work. It could work out great. It could also be really bad. It all depends on what the market's going to do. But the underlying problem is the fees are going to increase every year. Here's where my beef is. This is the hot one right now. This is the hot thing out there right now that everybody's like, you should do this one. Well, here's why they love it, because in the first decade, I can illustrate and run numbers and show you phenomenal estimations and phenomenal numbers, and it looks great. And you can use it for the banking tool and all that. It'd be awesome. But what about the next decade? Your fees are going up. If you ask the agent who's talking about it, they don't really want to talk about the next decade, right? The second decade or the third decade, because it's going to blow. It's many times it just blows up, okay, and it doesn't work in the long run. I like using the whole life tool because, again, it's called whole life. Don't confuse it for any other reason. It's because the costs and fees are guaranteed for your whole life. So are you paying a little more for your fees and cost of insurance in the earlier years? Yes, but you're paying a lot less in the later years, and it's averaged out. So you're paying the same, but it's level, it's steady. And your fees and cost of insurance are also guaranteed. So that means you have a guaranteed annual cash increase, Trish. My analogy is this. You can do universal or index universal, you can do whole, they both can work, but the analogy is when you buy investment property and you want cash flow from that property, because we all know Trish is a big real estate person. Do you want a fixed or variable mortgage against it?
You always want fixed.
Why?
Because you know what you have, and you know how to manage the property or the investment.
You know your return, right?
Right.
Well, same thing here. The whole is the fixed. The universal is, or index universal is the variable loan, variable returns.
And realistically, in some real estate situations, the variable would be good, but it's very short term, and you know exactly what's going in, what's going out. Yeah,
I agree. And sometimes in certain situations, the index universal can work if it's a shorter term plan. You know, in the next 5 years, I'm going to do this, and then I'm going to move this out to something else, which leads to your last part of your question. Should I wait? Well, one of the catches to all this is you have to qualify for life insurance, right? When is life insurance the cheapest? Now or later?
Now.
Always. Now. You're younger, right?
Thanks for saying now.
Yes. So, and none of us can predict our health in the future, right? What if we have a health issue? We could be in a position where we can't get this, or it can be cost prohibitive. I'll put it that way. So when should you try to qualify for this? Sooner rather than later. Now.
Yeah. And I have to say, Greg and I learned that using this tool and using this vehicle, we should have done this when we first started chatting about this and not wait the way we did.
Yeah, you lost 2 years.
Yep, and that can segue into, now what do we do?
It cost you a little bit, but better late than never.
Well, now we're on a track, and it makes sense, and we just keep putting dollars into our cash bucket, and we just tell the kids, hey, we're spending your inheritance, but at the same time, because we understand combining the investment, you'll make money in the long run, but the cash is still sitting there, so that's pretty cool.
Exactly. Did that answer your question, Trish?
It did. Thanks, Ferenc.
Thank you, Trish.
Thanks, Trish. go ahead and mute
All right.
her. Okay,
Okay.
so you have a couple different options. We have two people that I haven't found out where they're from yet so that I can open up their mics.
Okay.
I'll wait to see if they can answer me in the chat room. In the
All
meantime,
right.
do you want me to go through and just let you kind of do your thing, and then we'll
Yep.
open up the Q&A towards the end? All
Let's do
right.
that. All right. So
So,
let's go to an advanced concept. And again, in the honor of 9/11, I just, members of that, I just want to touch on what do you do when things go wrong? And certainly things can go wrong. How do you protect yourself from that? And I've already touched on it a little bit in terms of thinking like a banker versus an investor, but I want to delve into this a little further. And if we have some time, we'll of course go into combining investments. Okay. First of all, I just want to show this chart. This is an S&P 500 index chart since 1997 to basically a couple of days ago, Friday actually. And the reason why I show this particular chart is this is my career in the financial industry. So I'm intimately familiar with this. I've been an advisor through this whole process. And when I started in the first few years, we were in what was called what later become known as the dot-com bubble. And it wasn't called that at the time. Nobody knew, but that's what it became called. And we had a historical increase in the stock market. That was the highest increase in the stock market's history at that time. Then around 2000, actually March of 2000, I know because I was playing golf that day. I lost a bunch of money that day. The market turned. And it was going down for about a year until we had something happen 17 years ago today called 9/11. And actually the market was looking like it was going to hit a bottom, and it was kind of looking like a recovery, and 9/11 happened and we had a 6-month free fall. My wife and I, Dawn and I, purchased our first home together. We got married 18 years ago actually, and we moved in 9/10. So we got up the next morning, first day in our new house, with the shock. So that's why it's really poignant for me. Our house that day, we looked at the price of what we paid for it and all that stuff, what it was worth. It lost $100,000 in value that week, and it kept going down from there. It lost roughly half its value. That's in Phoenix, okay, and it was a nice home. But the bottom line is, the real estate values took a dive too at that point. The market went into a free fall basically for the next year and a half. Okay, then we had a recovery. Starting in about 03, we recovered till 08, and that became later known as the mortgage bubble. It wasn't called that at the time. Nobody knew what that was at the time. And oh, by the way, there were articles both of these times that said the stock market will never go down again, and the Dow is going to hit this, and crazy things. Bottom line is, most of us remember 08, 09. By the way, this downward trend was a 45% drop. 08, 09 was a 55% drop. Now, the one thing I want to point out, and I always point out to people about this, if you look at the angle, it took about 2.5 years top to bottom, from 2000 to basically 2003 is where we hit the bottom. This one took about 18, well, it was half the time. It was about 18 months top to bottom, not even that. What was the difference between 2000 and 2008? I'm going to tell you what the difference was: technology. In other words, things moved faster, didn't they? And trades move faster, and that's why the market moved faster, especially towards the downside. When it goes down, it tends to go down fast. It goes up, it'll go up, 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 up. But when it goes down, it usually goes down strong. What do you think technology is like now in 2018 versus 2008, 10 years ago? Is it faster? Of course it is. The point I'm trying to make here is I'm not a fear monger. I'm a pretty optimistic guy, and in the long run, I believe in the future of our country and the economic thing. And I'm not a big fan of precious metals and buy gold and I'm not a prepper or any of those kinds of things. But what I am saying is this: these cycles that I'm showing you, by the way, this top here is what's called a ceiling. The bottom here is what's called a floor. That's why I put those two lines in there. And you notice I can take this chart back 100 years if you'd like, and you'll see the same basic cycle. It tends to hit its head on the ceiling, tends to bounce off the floor, okay? But something happened about 2013, 2014, and it broke through the ceiling, which is known as an anomaly, not normal. Now, what caused this? Well, basically, right at this point here, the Fed started buying bonds. First TARP, then QE 1 and 2 and 3 and all these things, and they artificially inflated the value, printed money, all that good stuff. By the way, at this point right here, the Fed stopped buying their bonds. So look what happened to the market, stopped going up. And then at this point, the Fed announced that they're going to keep historically low interest rates in place. They didn't stop buying bonds, but they're going to keep the historical low interest rates. So, okay, we'll keep going. Look where we are now. As of Friday, we are in uncharted territory. And all I'm going to say to you is this: what goes up must come down. I can't tell you when, I can't tell you how much, I can't tell you how far. But what I can tell you is it will happen. We also, a couple weeks ago, this is the longest bull market in the history of the stock market. If you have investments that are at risk to the market, I strongly, strongly, strongly encourage you to start protecting your downside. Because can it go up from here further? Yes, of course it could. But where is the risk highest? Here, up here where we are now, or down here where we were in 2009?
And let me ask if anyone can see this chart right now. I'm getting a couple people saying they can't see the chart. Can anyone chime in and let me know? Can you see the chart right now? Is it just one person? Apologize. I can see it, and I just wanted to make sure.
I had my camera on, so maybe that might have been blocking. So
okay, go ahead. Sorry, I apologize.
Sure, no, that's fine. So this is important things to understand. So how do I protect how do I get myself protected from the downside? Well, I already shared with you one thing is think like a banker versus an investor, and that is protect the downside by creating cash flow investments. Dividend paying stocks are another one. Tax liens are another one. Bonds are another one. I'm not bonds, but notes, real estate notes. Rental real estate is another one. I mean, there are a number of different, and there's others, investments that create cash flow. Okay, but the other point you want to be concerned about is protecting the downside. Now, I'll give you a quick example. I was big in real estate investment, as many of you know, and I made a mistake. I didn't know about all this back in those days, and I had some rental real estate and sold it, developed, and then everything, 08, 09 happened and got creamed, right? If Dawn and I had 22 rental properties at one point. And I don't like to bring this up too often because it frustrates me. But if we had chosen to, if we had chosen to keep those properties, okay, and here it is. What would we have done? And by the way, they were in Phoenix, so what would have happened? They would have lost half their value, right? But what we did is if we would have created a secure cash flow. They were all positive cash flow properties. Who cares what they're worth? Who cares about appreciation if you're getting it for cash flow? And one of my mentors, actually, I spoke to him today, John Burley. Some of you know that name. He's a big real estate investor and teaches and trains worldwide, actually. And he's actually the real estate mentor for Robert Kiyosaki and Rich Dad Poor Dad. He's also a best-selling author and all kinds of stuff. And by the way, it looks like he's joining us at our board meeting next week. It looks like he's very interested in joining the board of our Real Salado Bank here. So it's pretty exciting. My point is, as he says, the same thing. If you buy cash flow properties, rental real estate for the cash flow, what do you care what the price is? What do you care what it's worth? You shouldn't. It doesn't matter. All that matters is what's the cash flow? What's the income? Okay? It's that simple. And he said the only time he owns over 2,000 single family residences in Phoenix alone. And he's been doing this for 30 years. Because the only time I sell a property is when I get it back, the neighborhood is creeped. In other words, it was a nice neighborhood, it's not so much. And I can sell that property, buy another one, and create a bigger cash flow. If I can do that, I'll sell it. Otherwise, I just re-rent it out. I never sell it. It's pretty smart, okay? Because remember, we talked about earlier, it's cash flow, and you're protecting your downside. If they don't pay you, you take the asset, right? So the personal bank does the same thing, as we talked about before. If you access money against your personal bank, as I was going through earlier, you access funds from it. What happens to your cash value? Well, all it does is just keep going up. It doesn't matter whether you take the funds or don't. It just keeps going up, which means you have more cash flow. Are you protecting your downside? I use this as an example with the Dana with the education loan. What if you had an investment? Let's use it in a quick example, protecting the downside. What if you had $100,000 and you wanted to invest it in some type of investment? I really don't care what it is. I'm not here to tell you what to invest in. But let's say that investment went kaput. It went to zero. Everything that could have gone wrong did, and you lost every dime. Well, if you did it the traditional method, you put $100,000 in that investment, that money's gone forever, right? What if, though, instead you put it in the personal bank, borrowed it against the death benefit, accessed against the death benefit, as we explained here, over time, and then that investment went to zero. It'll take a little time, but guess what happens? You get all your money back through the interest that's earned in the policy. And this is the part where I don't like to think about a whole lot, because we had our real estate when we were developing and all that. We became developers. We had $4.5 million real estate in 08 when the crash hit us, and a lot of it was land and various stages of construction. And so $4.5 million of property as appraised value went to $1.5 million in 14 months, and we owed basically $2.5 million. So I went about $2 million in the black to $1 million in the red in just over a year.
Wow.
If we had done it this way instead, this is where my passion comes from and why I share this so strongly with people. If I had known in 2008 and prior and done it this way, and I didn't, that's my regret. I wish I had known. Instead, what if we had that money, again, add a zero or two. This is 10 years later, isn't it? That was 2008. This is 2018. 10 years later, the 100,000 would be 162. We'd be 62% back, wouldn't we, on our losses? So that $2 million loss, I'd be 62% back today. Don't make me repeat that too often. It gets frustrating.
We'll use it in upcoming webinars just as a replay.
Right. That's, folks, how you protect the downside. Okay. Do we have any other questions on that?
We have several hands going up and several questions. I've got a couple people queued up and ready to go. Let me just get to it. We've got Douglas from Colorado. Let me go ahead and unmute. While I'm doing this, I'm going to go ahead and launch another poll. If you'll please go ahead and answer that. Let me get Douglas's mic open. Douglas, are you there?
I'm here.
Hi,
So
go ahead.
Hi, Douglas. How you doing?
Good, thanks. Hey, quick question. As you talk about this compound interest concept and the gross cash that's generated, and then the last slide you showed, you started at 100,000, 20 or 10 years later, you're 162,000. How do you ever access that cash, or do you?
Yes, great question, by the way, Douglas. You actually can access, so obviously you don't have 100% liquidity day one, right? So how it works is, so I'm using my example here. When I was using the example of you've got your gross cash up to 100,000, okay? And again, it could be done all at once, or it could be done over a period of time. Now, the liquidity day one on these contracts is about 60 to 85%, depending on your age, health, and how we structure it. So that's the range, okay? Everybody's a little different. So if you put in 100 day one, you could turn around and access, say, 80 of it, literally the next day if you wanted. Now, over a period of a few years, that liquidity increases up to 100%. So your liquidity is going to be 100% by year 4 to 8, again, depending on age and health and how we structure it, okay? So my point is, if you put a chunk in and you want to turn around and access it quickly, you'd have access to the majority of it. If you funded it and let it sit a little while, let it season, as we call it, give it a year or two, you'd have access to all of it, okay?
And does the
against the
access go against the death benefit?
correct. Correct.
Okay.
So just like in my example where I showed here, where you decided to access 50K, right? Where did the 50,000 come from? You accessed it from that future death
Yeah.
benefit in our example of $1 million, right? So it's now 950, right?
Yeah.
Here's what's so cool about this, Douglas. An analogy I use all the time is this. If you had $1 million house and you had equity in that home, could you borrow against it?
Yeah.
Sure. And what you're doing is when you're taking a line of credit or a mortgage or whatever against that property, the collateral, the asset is the home, right?
Right.
You're accessing a portion of the future value of the home of when you sell it. So when you go to sell it, let's say you sold that home, let's say you had $1 million home, you had a $50,000 loan against it, you get $950 in proceeds, wouldn't you?
Yeah. Yeah. That's a good analogy. That makes it easy
Perfect.
to understand.
Exactly. I use that one all the time. I've got a slide on that somewhere. I'll find it. Did that answer your question?
Yeah, it did.
Yeah.
So
Works in the
what's
same principle.
interesting about this concept is I'm earning cash on that cash while I'm borrowing against it and earning more money.
Exactly.
I'm a asset-backed lender and also a real estate investor.
Perfect.
So
Well, you kind of led me into the combining investments. So let's talk about that a sec. So let's just go ahead and jump in there because we'll segue there. And we'll finish up on this thought and then any other questions.
Perfect. Douglas, I'm going to go ahead and unmute him right now.
Okay. Thank you, Douglas.
Thank you.
So just kind of what Douglas was starting to share, the synergy of combining investment is powerful tool. Think about this a minute. You set up a bank, a personal bank, like we talked about. What's it going to do? It's going to generate interest. And let's say you put in enough money, you can do it all at once or over a period of time, doesn't matter, that you have enough money to purchase a secure income asset. Now I'm using an example of a house. Again, it could be notes, it could be dividend paying stocks, it could be anything. I don't really care, as long as it's a secure income asset. Now that asset is what's it going to do? Create cash flow, right? Now, if you don't need that money to live on, if you flow that cash flow back into your personal bank, what's going to happen? You're just going to have more money, aren't you? So it's going to go fast. This is like a circle. It goes faster and faster and faster. So as you get more and more money into your bank and interest earned in your bank, could you then purchase your second income asset? The answer is yes. And so now what's that second one going to do? Throw more cash flow. If you flow that through your bank, eventually you'll have enough money to do a second bank, won't you? Which both banks are now throwing off interest, and both income properties are throwing off cash flows. And this can be multiple banks, multiple income assets. This process speeds up faster and faster and faster. And so what happens is personal bank in conjunction with a secure income asset creates a money engine, as we call it. It takes a few dollars, it generates a lot of dollars. And I've got a spreadsheet here that I can jump to as soon as I find it, that kind of lays that out. Since you were a lender, as you put it, we did this spreadsheet for a CPA and a hard money lender, and then a couple other CPAs and numbers people have asked us to do this for them. So we send this to them, and now I can't find that. But it shows how your total returns, here it is, increases every year. So Douglas, basically, what we've done, this is for a 50-year-old. So if you were younger, your cash numbers would be a little bit higher. If you're older, it'd be slightly lower, but it's going to be very similar, okay? And so we have stock market investors, many times they'll tell us I get 7% on my investments. We have hard money lenders, real estate people that tell us they get 12% on their investments. I'm not arguing with them on what they get. I'm just going by with what they tell me. So I say, look, you can either get your 7% stock or 12% real estate investment return, and you can keep doing what you're doing, and that'll never really change. You're not going to make more than that, but that's what you'll make. They're like, yeah. Or you can take that money and flow it through your policy, your personal bank policy, borrow against the death benefit, what's available, and then take that money and invest in your 12% or 7% investment. So bottom line, Douglas, is what we use an example of the most conservative one. By the way, we used a 50-year-old smoker, so we put everything against us, okay? And 60% liquidity, and I told you it's going to be 60 to 85% liquid day one, depending on your age, health, and how we structure it. So I went everything against us and was as conservative as could be, because I'd rather show you these numbers and then come back and show you how it's actually better for you. But the bottom line is this: if you get 12% on your, if you get 7% on your investment, we'll start there for a second, and you just invest in the market, you're going to get 7%. If you flow it through your personal bank, let's say you put in 100 grand in your bank, then you borrowed 60 against it and invested the 60 into your 7% investment. What's your total return? Well, you get 7 on the 60, plus you get 5 on the 100. You combine the two, and you get 8.84 total combined return. And then the next year it goes up because you got compound interest in your personal bank policy every year thereafter. The synergy increasing, compound interest. If you have a 12% investment, same thing. If you put in 100 grand and borrowed 60, made 12% on the 60, and you're making 5 on the 100, your total combined return the first year is about the same, 11.94. But look what happens the second year, and the third, and so on. I have clients that are doing this. They're in their third and fourth year, and they're making 13, 14, and 16% actually in their money. And they're pretty excited about it. And by the way, Douglas, the last thought on this, part of it is insured, guaranteed, and tax-free, isn't it? Your 12% or 7% investment may or may not be, but the other portion through the personal bank policy is. So you're getting some tax benefits, you're getting some protection benefits, and you're getting a higher return. Oh, and you got liquidity and control of your money. Show me something that works better than that.
Show the illustration again. Take yourself off. For some reason, there's a little glitch in the system. I think if you take yourself off, they might be able to see that.
There we go. Is that better?
All right. Rance, can you see that?
So the bottom line with this is, no matter how you cut it, people ask me, well, should I do this investment or that investment? I get that one all the time too. Should I do this or that? This looks pretty interesting, but I'm thinking about, should I do this or what I'm already doing? Well, that's a mistake. You should do both. And I guess I'll leave it this last thought unless we have another question. If you got one, go for it.
Okay, so let me go ahead and open the mic for Frank. He's originally from Las Vegas, but I believe he's in Utah now. So let me open up the mic for Frank.
Okay.
Mike, you're on the air.
Can you hear me?
There you go, Frank.
Yep. Hey, Frank.
Hi, Ferenc. I'm a longtime listener, first-time caller.
I love it. Welcome.
Thank you. My question is, if you take some, like, let's say you have 100,000 that you put into the cash bucket, and then you have $1 million, just using that as the example.
Right.
If you took 100,000 from the death benefit and started a new insurance policy, can you do that?
Yes, you can. Now,
is it worth it, or is that not something that you should do?
You absolutely can do it with a couple of caveats. And what you're leading into is what we call branch banking. Okay, so we'll leave on this thought, because this, for a lot of people, one of their most fun techniques and advanced concepts they love. So bottom line is, can your first bank fund another one, right?
Yeah.
And the answer is absolutely. Now, there's a couple of catches, okay? The catch is this: on all these banks, your crediting is, your interest crediting is vested the first 2 years. You're vested after 2 years, so you're not vested the first 2, right?
Right.
So yeah. So because of the vesting schedule, you want to get past that 2-year period, okay?
Okay.
So what we always say is the third or fourth year, you're usually at 80% liquidity or more if you have one of those 60% plans. Okay, if you have
Right.
one of those 80% plans, you're at the 90, 95% range by then, or 100. Okay, but let's say
Okay.
conservatively speaking, let's say like you said, you did your 100 grand or your 10 grand, or let's say you're doing 10 grand a year. Just use nice simple round numbers, and you do that for a couple of years. We get to year 3. Can we say you're at 80% liquidity on your money now? Could you access 80% from the death benefit, take that 8 grand, and fund bank number 2? And the answer is yes. Now, what would that do? Literally what happens is you're making 4 to 5% on the money in bank 1. Now, why do I say 4 to 5? The contractual minimum guarantee is 4.
Right.
Okay.
I get that.
Yep. They're currently paying 5. Historically, they pay around 6 or so. That's the 6.5 is long-term realistic expectations. But I say 4 to 5 to be conservative. Bottom line is right now you're making 5. You make 5 on your 10 grand, plus you make another 5 on the 8 you put in from bank 1, right?
Right.
You didn't put any more money in. It funded your first one, funded the second one, right?
Right.
You just keep feeding number 1, just like you were planning to do. Now, by the way, could you repeat that process 2 or 3 years later?
Of course you could.
Exactly. And that's when it gets really interesting. As long as your health is good and stays good and stuff like that, you can continue to do this process. One of my mentors has 29 of these. He's been doing it 16 years.
Awesome. Okay.
So the answer is yes.
Okay, fabulous. One other question.
Yes.
In the past, I've heard you talk about things like JCPenney doing this.
Yes.
Did JCPenney do that as an individual or as a company? I mean, is it possible to do it as a company?
I got asked that question by that high-powered attorney today. So, and the answer is yes, with some caveats, right? In other words,
Okay.
there's always a way, and and this is some of the information that we send out to folks. So if you've heard before, or been on before, Kelly's probably sent this to you, or I have. You've seen sideways. Sorry, folks.
Just so you know, I'm here with Gene and Gidget. They're the ones who got me
Okay,
here.
perfect. So
Right.
yeah, we send out this, famous examples of famous people who have used this tool: Walt Disney, Bob Hope, Roosevelt, Walmart, Sam Walton.
Right, I've seen this.
Yeah,
I've seen that.
JCPenney. These are all McCain. John McCain used it to fund his presidential run, by the way. So use his policy. Now the question is, can you do it personally or corporately? The answer, of course, you can do it personally, always. Corporately, there are, if you're willing to jump a couple hoops, there's a couple structures you have to set up. You have to use like an LLC and a trust and stuff like that. But can it be done? Yes. So you can get some tax deduction.
Would they still treat it like a life insurance policy? I mean, would you still have to go through
Yeah.
would you, as the CEO, have to get the physical, and
Yes.
would it go up by your age and stuff like that?
Yes, exactly. So in other words, it's what that typically is used is most commonly is what's called key person insurance. Some people are familiar with that term, particularly in the business community. That's where if you have 2 partners, like this law firm is a perfect example. 2 founding partners, both nearing retirement, and the younger partners, they have like 200-300 attorneys in their firm. Okay, so these are big firms now. And like he said to me today, he goes, the mistake we made starting this out, we had no idea it was going to blow up into something this awesome, big. It's awesome, but we had no idea. And we got to figure out a way out, and we're going to get creamed on taxes. The younger partners want us to kind of move out, when I'm saying move out of the way. And they're willing to do that. They're willing to pay us, the firm, to do that. And could we have the firm fund this? And obviously the firm will get a tax deduction. And yeah, because they're key people in this firm, right? The 2 partners, the 2 founders, right?
Right.
So key person is used often when there's a key person or partners in a business, and what it's doing is protecting the other partner, in case something happened to that person, right? So, and there's nothing in the laws that state what type of insurance you have to use. So if you want to use a high cash value contract like this to maximize cash growth, but also protect the partner at the same time, it's perfectly legal and ethical to do so.
Awesome.
So in fact, he said to me today, He gave me all his information, all his numbers, and he said, run me the numbers. I'm super interested. Let's set up a meeting. I have a tax attorney consultant I use with him. I want an attorney to talk to attorney, right? Because they talk their own language. He said, I'd love it. He goes, I'll be happy to pay for his time. I said, I can get a free consultation. He goes, even better. And he's very, very open to doing this because it just makes sense.
Yeah, it sure does.
Yeah, and he's been researching it for several years. Like he said, his only hesitation was he thought he'd have to fund it for 7 years. That's what he'd been told. And I said to him, that's not necessarily true. So, and that perked his ears and got him very interested. And we talked for about 20, 30 minutes. So that was today. So
fabulous. Thank you very much.
You're welcome. I think we're just about come up on time here. Are there any other questions, Kelly, we need to address, or
I think we can do it on the back end. I have one more poll to just pop up really quickly while you're getting ready to do your ending.
Sure.
This will just help us to know. Everyone seems really attentive tonight, and we want to thank you for everybody getting on the line and asking your questions live. These have been amazing. So thank you. Thank you.
Excellent. So basically, I'm just gonna, if you want some additional information, many of you have heard me say, share this. Great website to go to, Nelson Nash. He's the founder of this concept. He's been using it like 50, 60 years, actually. Infinitebanking.org. I have nothing to do with the website. Years, decades, literally, of free newsletters. You can really dive in deep understanding this concept. The next of the book, my favorite book, Financial Independence for the 21st Century by Dwayne Burnell. Best book on banking concept. There's about 12 books that actually exist. For those of you who've seen this before, my second favorite one, I don't have it on a slide, but maybe we show you. Be Your Own Banker by Nelson Nash. Great book. And then there's another one I've not shared with most people. I love this one, Confessions of a CPA. So this is a CPA that learned about how this works. And the author on this is Brian Bloom, B-L-O-O-M, B-R-Y-A-N, Bloom. And the title of the book is Confessions of a CPA. And he talks about this cash value insurance product and how it can work. And he's like, wow, everything I was taught as a CPA was wrong. I learned about this. So great resources to go to. Like I said, Kelly will be sending out a number of pieces for everybody to look at and review. If you have any questions, basically the next steps, real simple, is contact us. The next webinar, actually, we do these live. I recommend, joining us every time. It's different. The initial part's the same, and then we tweak. The advanced concepts change every month. So it's always something new. The next webinar, October 16th.
Yep.
I'm going to be in Denver. Oh, I got to change those dates. It is official. November 1st. I know what happened.
Yep, November 1st and 3rd.
And 3rd. I didn't save the new one. It's in a different location. But anyway, there we go. Be in Las Vegas, November 29th and December 8th. And then January 26th is our workshop in Phoenix. So we got lots of stuff coming up. But what's the next thing to do? Check, register for the next webinar, learn more on the 16th, invite friends, family, spouse, whatever. Same time, 6:30 Pacific. That's what we do every time. Same process. Like I said, if you've heard this before, you can skip the first 30 minutes. That'll be the intro. Join us at 7. You'll hear something new just about every time. And then the Q&A is always great. Thank you for the questions tonight. They were awesome. I really enjoyed it. Contact myself at semsecuremgt.com or our number, or the person who invited you, and they'll be happy to get more information to you, answer any questions, and we can start your bank when you're ready to go. We're very education focused. As you can see, there's no hard pressure. We want you to really understand how this works, how this can impact your future, and change your financial future, bottom line. Because we all understand this, myself and all agents who work with me in the agency. The better you understand this, the more likely you're going to use it, and the more effectively you're going to use it, and the happier you're going to be. The bottom line is this: you earn more income, you gain control over your money, and you have more money to spend over your lifetime. It's been a pleasure. Everybody have a great evening.
Thank you. Thank you, everybody. Make sure that you contact the person who invited you, and we'll see you October 16th, 6:30 PDT time. Thanks so much.
Check out our description below for a link to our upcoming webinar.